Everyone said artificial intelligence would save the markets. Not stabilize them. Not grow them. Save them. And for a moment, it did. Tech valuations soared beyond even .com mania. CEOs spoke of the end of human labor, governments promised AI transformation, and investors, from pension boards to teenagers on trading apps, poured their last dollar into the AI dream. But then something happened that no one at Davos, Silicon Valley, or Wall Street expected. The world did not crash when AI failed. It crashed when AI succeeded. Not because the technology malfunctioned, but because the market's belief in it became bigger than the technology itself. Today we unravel the chain reaction, the hype, the earnings illusion, the capital stampede, and why the AI boom is now reshaping capitalism faster than the market can price it. Was AI the greatest investment opportunity of the century? Or the most sophisticated bubble ever created by mathematics, marketing, and machine learning? Stay with me. The mystery is not whether the bubble bursts, but what breaks first when it does. In the next hour we will examine how AI stocks became too big to fail, why the top 8 AI companies held more market value than Japan, Germany, and the UK combined, how investor psychology turned models into messiahs, what happens when productivity rises, but employment doesn't, why regulators are preparing for a market structure shock, not an innovation boom, and finally, the indicators that the AI bubble is already leaking silently. The origin of the AI mania. To understand the AI bubble, we must go back, not to ChatGPT, not to 2023, but to 2008. When central banks slashed interest rates to zero, they did something unprecedented. They made risk cheap. They made capital restless. Pension funds, hedge funds, sovereign wealth pools, everyone needed the next frontier. Tech was the only narrative strong enough to promise exponential returns. Then came cloud, mobile, data, and finally, the algorithm. AI did not explode because it advanced quickly. AI exploded because the market needed something worth believing in. 2012, the deep learning spark. Neural networks prove they can learn faster than any model in computer science history. Investors whisper, if it learns, it replaces. If it replaces, it scales. If it scales, it prints money. The seed of mania is planted. From innovation to speculation. 2020 to 2024. Something extraordinary happens. AI stocks don't just rise. They detach. Nvidia, Alphabet, Microsoft, AMD, Meta, Tesla, Apple, Amazon. A handful of companies become the entire market's oxygen supply. Analysts repeat a slogan they don't fully understand. AI is inevitable. But inevitability is not valuation. Inevitability is belief. The self-feeding loop. 1. Hype fuels price. 2. Price fuels media. 3. Media fuels retail investors. 4. Retail enthusiasm fuels institutions. 5. Institutions fuel government adoption. 6. Government adoption fuels hype again. This cycle mirrors railroads in the 1840s, radio in the 1920s, and internet in the 1990s. But AI is different. Because AI is not just a product. AI is a replacement for the worker and a partner to the investor. Narration shift and quiet suspense. In trading floors, a phrase begins circulating. This time, humans aren't just outperformed. This time, humans are unnecessary. When winning becomes a threat. Here's a paradox that shattered analysts. AI didn't collapse due to fraud or lack of adoption or slow earnings. AI broke the market because it worked too well. Productivity versus employment. AI excelled at automation, text generation, code writing, legal drafting, accounting, cybersecurity, medical scanning. But its success triggered a silent monster: labor displacement with no wage growth. When workers don't earn, they don't spend. When they don't spend, corporate revenue stops rising. Share prices soared toward the sky, while the economy beneath them stopped moving. This is where markets panicked, not outwardly but structurally. Who loses when AI wins? 1. White-collar shock. The first victims were not factory workers, but analysts, marketers, lawyers, coders. AI didn't replace tasks. It replaced departments. 2. Education market collapse. Universities promised high-income technology futures. AI promised the same future with zero tuition and zero human labor. Enrollment declines. Degrees lose pricing power. 3. Talent premium dies. If machines outperform junior employees, the entire salary ladder falls apart. For the first time in capitalism, innovation did not reward labor, it erased it. Failed fixes, policy, regulation, and market denial. Governments responded not with caution, but with acceleration. Regulation committees were filled not with engineers, but with corporate AI lobbyists. They were asked, "How do we control you?" They replied, "You don't." And the market interpreted that not as risk, but as guaranteed expansion. This is where the bubble formed its hardest shell. Not in GPU prices, not in data centers, not in enterprise adoption, but in untouchability. If nothing can stop AI, then AI valuations are immune to gravity. This belief was the true contagion. Every bubble in history has 5 identical stages. 1. Disruption. 2. Narrative. 3. Leverage. 4. Institutional validation. 5. Denial of downside. Tulip mania. Rarity became religion. .com boom. Eyeballs were called revenue. AI bubble. Computation was called destiny. In every bubble, math becomes myth. In every bubble, markets say, "This time is different." But this time is different because the asset is not flowers or fiber optic cables or domain names. This time the asset thinks, and anything that thinks threatens the hierarchy of capital. The market's silent warning. The AI bubble does not burst loudly. It leaks. Indicators. Tech PE ratios flatten while revenues stall. Hardware demand overtakes software monetization. GPU supply exceeds enterprise use cases. AI power grids become cost centers rather than ROI machines. Betting on AI became more expensive than building AI. This was the market's whisper. We built more intelligence than the economy can absorb. The true risk, not crash but concentration. 8 companies hold the future of information, automation, medical diagnostics, defense systems, employment prediction, media generation, voting influence, financial trading. Markets are not afraid AI will fail. Markets are afraid only 8 companies will succeed forever. This is the opposite of capitalism. No competition. No wage negotiation. No price discovery. Investors don't like monopoly power, they like monopoly profits without systemic responsibility. AI forced them to hold both. The inevitable turn. At the heart of the bubble lies a single contradiction. We want AI to be perfect. But markets only function when humans are imperfect. AI improves too quickly. Markets need error to justify labor value, innovation cycles, and human consumption. When machines eliminate inefficiency, they eliminate profit mechanisms too. Capitalism was not built for certainty. It was built for competition. AI, if left unchecked, ends competition itself. 3 takeaways. 1. AI is not a bubble because it is weak. It is a bubble because markets price perfection. 2. The crash will not come from failure of technology, but failure of economic absorption. 3. The threat is not AI replacing workers, but AI concentrating wealth into fewer hands than any era in history. Final warning. We are entering a market era where productivity rises without wages, innovation rises without competition, intelligence rises without distribution. If capitalism cannot evolve alongside artificial intelligence, then markets will not burst. They will converge into a form we have never seen. Fewer players, fewer decisions, fewer winners, and for the first time ever, the invisible hand may not be human. If this documentary opened your perspective, share it, subscribe, and join us on this journey as we decode the forces shaping the future of money, labor, and power. This story is not ending. It is only beginning.